What's up, everybody? Welcome back to The Contrarian. I'm Logan Moody. Today I'll be talking about all of the recent short squeezes and rallies in a lot of the growth meme stocks out there. Basically trying to answer the question, why are these stocks rallying? Is this more of a shift in the broader market back to a risk-on type of mentality for this new year? Is this just a temporary short squeeze that's going to roll over soon once it's all burnt out? I'll attempt to dig into the data right now to get into that. Attempt to answer some of these questions as to why these stocks are rallying and could this continue. So, to back up a little bit, coming into the end of 2022, we basically saw a lot of growth stocks continue to sell off into the end of the year. A lot of this was likely due to tax loss selling. So basically, if you can lock in a loss in a position, sell it for a loss, you're going to basically not be taxed as much for any gains that you had for the year 2022. So that's likely a lot of what was factoring in to 2022 and the sell-off that a lot of these stocks had going into the end of the year. Not to mention that the economic backdrop was very weak. It was beginning to get worse. At least investors were thinking so. The Fed was seen as being, still hawkish, wanting to raise rates more in 2023. But jump forward into 2023, suddenly it seems like the market might have shifted a little bit in terms of its assessment on the Fed. Maybe now factoring in slightly less rate hikes for this year, at least in terms of seeing the likelihood of that actually happening. The market might actually be saying, it's very unlikely in our opinion that the Fed gets to their goal of 5 to 5.5% federal funds rate. It's more likely that they, maybe do 25, 50 basis point rate hike, and then they have to call it good there. So that's just kind of the backdrop of where we have been. But, since then, stocks like Tesla, basically anything in Cathie Wood's portfolio, which is very high growth, very high risk assets, have done very well the first month of 2023. Tesla is up some 70% from its lows. Zoom as well is up quite significantly, and other stocks like it. Needless to say, it appears to be somewhat of a shift back to risk-on mentality. A lot of this is likely due to short squeezes going on. So as stocks sell off, as sell-offs continue in their momentum, hedge funds, institutional investors like to get on board and short stocks. That comes back to bite you, of course, when the stock begins to rally in the opposite direction and you have to cover your position. So short squeezes are likely playing a part in these rallies. Gamma squeezes could be doing that as well. We saw this going in with the whole GameStop rally and meme stocks as well. Gamma squeezes played a big part where purchasing out of the money call options actually accelerates the buying activity to hedge the positions by the sellers of these call option contracts. So all of this could be playing in to why these stocks are rallying. I think the key question to ask is this a lasting maybe trait for the coming months of 2023? In other words, is this kind of what David Hunter was laying out as a scenario for a melt up or a shift back to risk on mentality in the market? Is this actually happening now? Because what Hunter is essentially laying out is, the Fed would essentially be likely forced to stop raising rates pretty soon. The market in turn would price in the Fed beginning to cut rates, and therefore investors begin to shift dramatically back into equities, back into growth stocks, back into gold and silver and things that do well when the Fed begins to ease. And then in response to that, the Fed then tightens even more and causes a big meltdown and market disaster. So that's basically David's melt-up thesis. But in order for that to happen, the market needs to believe that the Fed is done raising rates and that they're going to pivot very soon. The market is very anticipatory of what the Fed will do. The market needs to believe that that's going to happen soon, that the Fed needs to stop raising rates soon. So a lot of that is going to depend on how hawkish the Fed is in their coming meeting, how aggressive they raise rates, and the words that Jerome Powell uses, the um, anticipation that he gives investors for coming meetings, how aggressive he's going to be. So a lot of this likely has to do with what the Fed does, but what the Fed is going to be looking at is economic data. Is the economy continuing to get worse? Is unemployment, for example, maybe going up? They're also going to be looking, obviously, at inflation. Is inflation down close to their target? So right now, inflation is still a ways from their target, but let's say in coming months gets down to maybe 3 or 4%, the Fed might have to find that acceptable, to actually be able to sustain the economy. They might choose to prioritize uh, the economy over inflation. They might have to say, okay, we did not get inflation down to our 2% target. We're going to have to accept 3.5% inflation. They might have to accept something like that in the coming months if the economy continues to decelerate. So a lot of the things that would indicate the Fed beginning to pivot soon would be, economy continuing to worsen, housing market continuing to worsen. That's definitely the canary in the coal mine right now, it appears, because housing market is not doing well right now. So if the housing market continues to worsen, if unemployment continues to go up, it's gone up just a little bit, but if it goes up in a measurable amount, let's say all of these layoffs start factoring into the unemployment data, once that really begins to hit, the Fed could actually begin to say, okay, we're going to pivot soon, we're not going to raise rates anymore, kind of a thing. And at that point, the market could very easily jump into a risk on type of scenario like what David Hunter is saying. And at that point, it would be beneficial to be at least short-term positioned in risk on assets. So attempting to ride in, obviously in a calculated and assessing your own risk type of scenario, but it would be advantageous to be long assets that perform well when the stock market and the market as a whole is anticipating such a Fed pivot. Now, the other half of David Hunter's scenario is obviously that the Fed attempts to bring this rally under control in the form of tightening more. So he thinks that that would put a firm break on the melt up from there. But it would be actually advantageous to be long if the market in the 6 months type time period of this year actually does shift to a risk on type of scenario. So it could be somewhat of a repeat of maybe the first half of 2021. We'll have to wait and see. Some indications I would point to that the market has actually anticipated a Fed pivot would be the dollar continuing to sell off, treasuries continuing to rally. These would be maybe the two most important things I would look at. Obviously, if the broader equity indexes continue to rally, things like that. Gold and silver also would rally in such a scenario because investors saying, okay, the Fed is going to pivot, even though they have not reached their inflation target. We're going to go into things like gold and silver that protect in that kind of a scenario. So if Hunter's melt-up thesis is actually in play at this point, things like that, the more structural shifts, especially in the dollar and the treasury market, would begin to take place. So rates would be coming down in the treasury market, dollar would be coming down, the dollar index. So things like that would be shifting. Obviously, you'd continue to have growth assets rally, broadly speaking, but short squeezes probably would come and go in that, but you'd maybe continue to see something like ARK actually do well in these few months in the melt up if that's actually what we're entering into. But I just wanted to make this video to maybe attempt to answer the question of are all of these short squeezes actually something that is going to continue going on? Is it a sign that the market's beginning to go back into a risk on type of environment? And hopefully there's just some helpful things for you to keep an eye on. in terms of if the market actually is beginning to shift to that sort of a stance. So all this being said, let me know what you guys think in the comment section below. Are we going back into a risk-on environment, or is this just a temporary blip in the market for this year? I'd love to hear your thoughts down in the comment section below. And if you liked this video, just please consider subscribing. I hope to see all of you again.